Welcome to Real Estate 101. I think we're in week 10, is that right? And we're really only on the tip of the iceberg as far as where we are in the process. So we're going to cover everything, and this Real Estate 101 is going to be a fairly long class, so I appreciate you guys hanging with me, but hopefully you'll get some good nuggets every single week. Today is going to be really beneficial to you, and even more so to your clients, because the better understanding that you have of the loan approval process, the more you're going to be able to alleviate their stress. It really is stressful. I mean, I don't know if you've ever applied for a mortgage, but the fear of the unknown comes into play, right? You don't know what the outcome's going to be. Fear of the known sometimes comes into play. If you know that you have some skeletons in your closet, maybe, that you know are going to come out, credit imperfections, we'll call them. So the better equipped you are to be their navigator through that process, even though the loan officer has obviously a very significant role, you're more of a confidant to them, whereas he's more of a service provider, he or she, the loan officer. So we're going to cover the loan application and loan approvals today, and then next week we're going to cover credit reports. And we'll go through that in pretty good detail, because that'll benefit you personally too. If you've ever looked at your own credit report, a lot of times people have no idea what they say. And so we'll go through how to read them, how to repair them, how to interpret FICO scores, etc. So that should be a good one as well. So today we're going to learn about approval types first. There are terms in the industry that get thrown around quite a bit, and they aren't always consistently defined. So I'm going to give you definitions that I have used for 25 years and that you should be able to use pretty routinely going forward. And they make sense, right? So anytime you run into somebody that uses a different definition, you can say, well, why do you call it that when it's not, right? So we'll go through that. We'll go through why it's important to know the difference, because as you talk to consumers, they're going to say, hey, I've been pre-approved. And you need to understand what exactly has happened, because the consumer knows even less, right? They know even less about what went into their approval. But you'll be able to ask probing questions and get a sense of whether they're truly pre-approved, whether their credit's been pulled or not, etc. And that tells you whether it's really time to start investing your time, or maybe it's time to put them in touch with a better loan officer. Okay? And we'll cover whether they cost money and how long they take. And we'll cover whether or not it impacts your credit to get pre-approved. All right? Does anybody have an opinion on whether a pre-approval might impact your credit?
Is that it's not a hard inquiry, is it?
Look at you. You know more than... Yeah. So we're going to cover that next week, but I'll give you the short version here. So Vernon's question, is that a hard inquiry? There are hard and soft inquiries. An inquiry is when someone pulls your credit. A hard inquiry, by definition, is a creditor that pulls your credit with the intention of extending credit to you. A soft inquiry is a creditor that already has extended credit to you. So if I'm Wells Fargo Bank and I made Vernon an auto loan, and I just want to see if he's still in good shape as he was when I made him the loan, I can look at his credit again. That's called a soft inquiry, and it doesn't impact your score. This is going to be a hard inquiry, right? Because this is a mortgage company deciding whether or not they would extend you a mortgage. So it's a great question. That's like a loan approval 201 question, not 101. That's right. So good job. All right, so let's take a look. So we have a pre-qual or pre-qualification, a credit approval, and then a loan approval, sometimes also called a full loan approval. All right? So a pre-qualification, I'll just give you the explanation of what that is. That really is just a conversation. So two could be referred to me as a prospective buyer, and I could say, okay, two, why don't you tell me how much you make? How's your credit? Do you have a down payment? Okay, well then you should, based on what you've answered, you should be able to get approved for X. I haven't looked at her credit report, I haven't verified anything, right? That's a pre-qualification. It's basically like a cocktail napkin sort of evaluation. It is worth exactly what you paid for it, which is 0. Now, are there pre-quals that end up coming to fruition because they were accurate at the beginning? Sure. There are really good loan officers that are experienced that can listen and they can tell how you answer or how a borrower answers that question, whether they're, embellishing or just flat out lying, right? And then they'll ask more probing questions. But if I talk to Vernon, who owns 6 Subway shops, and I say, what do you make? He might say 10 grand a month. If I look at his tax returns, he might lose 10 grand a month though, right? Because he's self-employed and he's taking advantage of all the tax codes and he's writing everything off. You guys are all going to be independent contractors, so hopefully you take advantage of the tax codes as well. Not too much, because I don't want to get audited. But then I talk to 2 and I say, well, what do you make? And she works for Boeing, been there 20 years. And she says, I make 6 grand a month. It's probably a salary. I can probably rely on the fact that A, she's an engineer, so she's not going to exaggerate because she's a C personality, right? And so I know that number probably a little more reliable than somebody who's self-employed. So those are just 2 extreme examples, but that's where a pre-qual could be more reliable, but it has 0 value to a seller, right? If I'm getting a letter that says this borrower has been pre-qualified for $200,000, that is an absolute waste of paper. Because pre-qualified to me, no credit was pulled, no income verification was performed, no asset verification, no title appraisal, or no second credit report, right? So pre-qual can be, it could be like an AVM. You know how we always kind of take shots at the AVMs? They can be a good starting point, but statistically they're wrong 100% of the time. It's just by how much are they wrong, right? So a lot of people will go to Zillow and go, well, let me just get a ballpark figure. That's kind of what a pre-qual is, a ballpark figure, okay? Now credit approval means exactly that. They've looked at my credit, right? Now before they can pull my credit, they have to have my social security number, right? They also have to have several other pieces of data. So what they end up doing is taking a full loan application and then pulling credit. So now they've got a list of answers to questions. We're going to go through this. And a credit report that is factual, right? So this, we hope is truthful, but we just don't know. But this, we can rely on because this is third-party verified credit report, right? So now, I'm credit approved. That gives a seller, to go back to my earlier example, a higher level of confidence, right? Because, yeah, they may have exaggerated how much money they have in the bank, and yeah, they might not be exact on what their take-home pay is every month. But in general, people are going to be, for the most part, honest on their applications. We still have to verify and get down to the fine-tuning. But the credit score, you can't fake, right? You either have what you need or you don't. So if the lender says, based on their answers to my questions and this credit report, they qualify. That's way more compelling than a pre-qual, right? If you were selling your house, Diane, does a credit approval give you the comfort that that buyer's offer is gonna close? It shouldn't. Because it still doesn't have any verification of what was given in the way of answers on the credit report. Right?
Is that true that after we accept with the credit approval and then the loan processing go after, in order we accept it?
Yeah, so you're in this position of kind of being a gatekeeper as the agent, right? Mm-hmm. You don't want to be your own sales prevention department like we were talking about in our meeting earlier. But you also want to be helpful to your client and coach them. Hey, that's awesome that your credit scores are where you need them to be. Now let's get all your documentation into your loan officer so the underwriter can evaluate your pay stubs and W-2s and bank statements. Because what you and I and the seller really want is a full loan approval. The problem with a full loan approval is it takes time. Because your client has to assemble all the documents. They have to go in and be reviewed by an underwriter, and a decision gets made. So that could be 48 hours. Some lenders are aggressive and will tell you 24. Many will tell you one or the other and be wrong, and it'll take longer. But the steps are the same for you. Nice to meet you, my new buyer client. Have you been pre-approved? No? Let me introduce you to Tyrone. Yes? Okay, great. What did they do to pre-approve you? This is where we get back to the consumer's idea of what pre-approval is. And they'll say, well, we just talked to him on the phone. Okay. Did you fill out a loan application? No, it was just a conversation. Boom. I know now immediately that they think they're pre-approved, but they're really just pre-qualified. And so my coaching is going to go one direction. If they say, yeah, I went to their website and I filled in an application and then he came back to me with this letter, okay, great. This means that they probably pulled your credit. Did they tell you they were going to pull your credit? Yeah, they did, because they have to, right? Okay, now I know they're here. Have you sent your pay stubs and bank statements into your loan officer yet? No, we haven't done that yet. Okay, now I know where I'm going to apply my pressure, because I want to make sure that they get that stuff in so we can move to this last step as quickly as possible. Your whole goal is to help them find a home and successfully acquire it. Your secondary goal is not to waste your time in the car with somebody that can't buy, right? So do these distinctions make sense? It's not rocket science, but people confuse them all the time. So what are the risks of those types of scenarios? Well, if you're dealing with somebody that's pre-qualified only, it's a risk that they may have given the person that pre-qualified him misinformation, right? It's a risk that their credit can change, right? When the guy pre-qualified him, he probably said, how's your credit? Oh, my score is 800. And then they pull the credit and it's not 800, right? That happens all the time. I'll bet you each have a number in your head of what your score is. Well, that number is whatever your score was last time it was pulled. Statistically, there's a 100% chance it's not the same today. And I'll explain next week why. Right? Liabilities can change. Appraisal and title issues, that can happen. Same thing can happen on a credit approval, right? A borrower can lie because what they put on their application has yet to be verified. It's only through loan approval where you've verified everything that you have mitigated your risk of misinformation, right? Can the credit score change on somebody while they're in your car driving around?
Mm-hmm.
Absolutely.
Depending on how much they use a credit card.
Exactly. So you want to coach them. Hey, no big purchases, right? Once your pre-approval is secured, you want to keep everything as much as the same as possible. That's why on that last screen it said secondary credit report. Did you notice that on the bottom row? I forgot to stop and talk about it. It's a quality control credit report that gets performed the day before funding. Imagine how catastrophic it would be for your client and for you if a credit report got pulled the day before closing and the underwriter said, oh, they bought a washer and dryer, their debt-to-income ratio doesn't work anymore.
Quality control.
Credit report. QC credit report. Right? Now some banks do that a week ahead of time, most of them do it 48 hours ahead of time. But most of them do it. So that's why you want to always be coaching your client. Hey, no big expenditures, don't run up any credit cards. I know you're buying a new house and it's exciting and you need a couch, but let's buy that the day after closing, not the day of or the day before. Because you wouldn't want to jeopardize the house and no longer need the couch, right?
Right.
All right. Liabilities can change. Not our borrowers, not our buyers simply means because we're going to coach them. Okay? So, Make sure you communicate clearly with your loan officer, right? As an agent, you want to know exactly where your buyers are at in the process. If they're coming to you saying, I'm pre-approved, and they don't even really know what was performed in order to produce that pre-approval, call the loan officer to find out. Hey man, is this a pre-approval or just a pre-qual? Okay, it's pre-approval, just credit, or have you already looked at their income docs, right? Those are probing questions that help you really get after whether or not these folks are fully approved, all right? Make sure you know exactly the status of their approval and type of approval, because you're in a position to influence them. Hey, when we went out on Saturday, you said you were going to send your pay stubs and W-2s in on Monday. Did you do it? Oh, you didn't? Why not? Come on, man, right? You're not berating them or nagging them, but you're using a little bit of guilt to get them to get their stuff in there. Because there's still potential that they think they're approved, you know they're not, and then they send in their pay stubs, bank statements, and W-2s, and the underwriter says, we can't make this loan. All right? Or we can make it, but they can't afford $250, they can only afford $200. So that's the benefit to you of getting to that last phase as quickly as possible. Put yourself and your client in the best position to win. All right? So, any questions on the different types of pre-approvals? Piece of cake, right? When you have a cash buyer, what do you worry about?
Proof of funds.
Proof of funds.
For the fund.
Yeah. A lot of people think, oh, a cash buyer, I have no worries. You got worries. At least until you can see that, right? I had a $5 million cash buyer. And it was only when I told him I'm not writing anything up until you send your bank statement that it became clear he was fraudulent. Better to find, I mean, heartbreaker, right? If you start doing the math on those commissions, but better to find that out on day one. So you only need to learn that lesson once, so learn it from me, so you don't have to go through the emotional roller coaster, all right?
Do you always send in a verification of funds on a cash deal? With the
Banks and short sellers will require it because the short seller's bank will require it. You don't have to do it with a retail seller. It's certainly prudent. You know, if I'm trying to kind of screw them down on price, I might say, hey, I know it's a little low, but I got proof of funds right here, man. They're ready to go. This money's yours. All you got to do is say yes. But a retail seller isn't going to require it like some of the others. Okay? All right. Now we're going to talk about the 3 C's of lending. Has anyone heard that before? Did you hear it from me?
yeah.
Okay. I was writing this going. Some of this I think I may have said. But now it's being recorded, so this is beneficial. All right. So we're going to talk about the 3 C's of lending, and it's really designed to be kind of an evaluation tool for an underwriter. But it's an important tool for you as an agent because you can start to understand where they might get into some trouble, right? We call it the 3-legged stool. What happens if any of the legs are weak on a 3-legged stool?
Fall.
Yeah, you're going to fall. And if you weigh as much as I do, the whole stool is just going to explode. Right? All right. So what happens? 3 C's are capacity, character, and collateral. You weren't thinking carpets, cabinets, and countertops, were you? Okay. Yeah. All right. So this is an underwriting environment. Capacity, character, and collateral. What do you think capacity means?
Will you be able to pay the loan?
If you'd be able to, yep. How about character?
Character is, I know collateral character I cannot think about.
Say it a little louder.
Oh, credit is character.
Yeah.
Oh, credit.
All right, so we'll go through them one by one. Have you been through training?
Through training?
Like a finance company or something?
No, I'm licensed. Yeah.
Licensed.
Agent.
No, I knew that.
Oh, you knew that? Oh,
But
no.
this is underwriting.
Yeah, no, I've been watching. I've learned some
All
great
right,
stuff.
that's good. All right, so capacity, you're exactly right. Whatever your income is dictates your capacity to repay a loan. If I'm going to lend you money, I want to know that you can afford to pay me back, right? And that's easily verified unless you're Vernon and owns 6 Subway stores, right? Pay stubs and W-2s for wage earners, that's really easy. You want to, just like they make a QC credit report pull a couple days before closing, they'll also call your buyer's employer and make sure they are still employed. Because if you get laid off, that's a problem. When Boeing announces pink slips are coming out, every Boeing borrower that has a pre-approval is in trouble. Because they are in trouble because they want to buy a house and now they're not sure they'll be able to pay it back. Or if they know they can because they have good savings, the lender's not going to let them buy it because they're not sure they can pay it back. They aren't going to go just based on your savings. They got to see your income, right? That capacity is, more simply said, your ability to repay. Vernon.
I have a question. So if they get a pink slip and let's say closing is before their termination date at Boeing, would they? I mean, are they going to ask, "Hey, is he going to?" I mean.
Yeah. No, they'll kill the deal.
Okay. Fine.
Especially with Boeing, because when Boeing announces layoffs, it makes national news,
Yeah. Okay.
right? If your Subway store is going to lay off somebody, they won't know, right? It's not going to be in the news.
But I think they haven't got a pink slip yet. How can the lender terminate the?
No, we're saying they did get their pink slip. When they get a pink slip, it's 60-day notice. Henry, that was in our meeting earlier today, he's going full time because Boeing is laying him off, right? So it's a real concern, and that's why they make that phone call and the day before closing to make sure, no matter who you work for, that you're still employed. Okay? So character is your credit rating. Some people are offended by the connection between how you pay your bills and that as a measure of your character. But it absolutely is. I think I told Diane this the other day. If you put 6 credit reports in front of me and 2 of them were attorneys, I could tell you which 2 because of how they pay their bills. And yes, I'm stereotyping them. And I have several friends that are attorneys, and I would tell them the same thing. But it has more to do with their income, right? They settle a case and get 200 grand, and then they pay everything. And then they don't pay anyone while they're working on the next case. So their delinquencies go like this, and then they're brought current. And then their delinquencies go like this, and then they're brought current. So character, though, is more a matter of, could you have somebody that makes $6 grand a month but doesn't pay their $80, Radio Shack bill?
Absolutely.
Absolutely, right? And that's a character flaw. They don't view that creditor as more important than going to the movies this Friday night or whatever else they were going to use that $80 for. And that's a matter of honor. When you borrow money, shouldn't you pay it back? Right? So, ability to repay is income. Willingness to repay is credit. You can have all the ability in the world but no willingness. You can also have all the willingness in the world but no income. All right? So now we get into collateral, the third leg of the stool, right? So the collateral is the house. I think I've said this on a previous video, but when you borrow money, you enter into a promissory note. The note defines the terms of repayment. The deed of trust is what secures the note to the house as collateral. And if you're ever having a hard time going to sleep, read your deed of trust. All right? So if you don't make your payments, they're going to take the house back, right? So now we have the ability to repay, the willingness to repay, and then the, oh, well, what if I don't pay? And you'll hear and read stories about, oh, these lenders just want to take the houses. That is a load of crap. They make their money lending it out. They lose money when they foreclose. Every REO that we sell is a loser for that servicer. They're getting back some of their money by virtue of selling it, but not what they lent out. Right? And that's all because values fell 35%. So if you're an underwriter or a lender, you want a sturdy stool. Right? Each leg should be just as strong as the next. That's the most stable place to sit. It's got to all be verified. So that was easy. That was a short one. 3 C's of lending. Like that? Character, capacity, collateral. All right, now we're going to get into the actual application. Not only the process, but the form. Okay? Who owns a home? Diane? 2?
In the past.
Okay. Did you get a mortgage, either of you, when you bought it?
Mm-hmm.
Okay, so you've been through this process.
Mm-hmm.
All right. This will be particularly helpful for you then, because you don't own a home
No.
and have it. Okay. All right. So the form itself is called the Fannie Mae Form 1003. All right. I think just the other day in training we were talking about the appraisal form 1004. That's Fannie's term as well. Right? We have HUD 1s. We have all kinds of different things. 1003 will always mean loan app. Okay? Good for you to know, because your loan officer may use that term to you, and you want to be able to say, oh, good, you got the app. Right? It's 5 pages in length. They can take it online, in person, or over the phone. What do you think most people want to do? Phone? Online?
If somebody don't use computer, they will use the phone. They
Yeah.
want to talk to people. But somebody work online all the time, they will pick online.
The bulk of borrowers would prefer to do it online. The shame of it is it'll take them 2 times longer to do it themselves without the loan officer on the phone with them. Because they're not sure, that they want to be precise, so they stop the app to go pull a bank statement and see what their actual balance is, and then they go, oh, well, actually, I think it's changed since the statement date, because that was 3 weeks ago, let me go online. And you get a loan officer on the phone, he says, how much is in your bank account? I don't know, 5,000, let me look it up. No, don't worry about it. 5,000 is close enough. We're going to get bank statements. This is an initial application, just like an estimated HUD, remember, with your closing. An initial application can be wrong all over the place. Hopefully it's in the vicinity though, and then you get the bank statements and you go, okay, it's not really 5,000, it's 4,992 and 83 cents. And they revise it and they send the final application to escrow to be signed with the loan documents. And those are typically marked up by the underwriter. Underwriter says, change all these values, update the app, and send it to escrow. Okay? So online is most common, over the phone is probably ideal. And that's useful for you, because when you're talking to your client, they may ask you, yeah, he told me we could do it on the phone or online, what do you think we should do? You'll get questions like that all the time. Well, if you know your information off the top of your head, do it online. You can do it, 11 o'clock at night. You don't have to worry about finding an appointment to do it with your loan officer. But then you could advise them, and don't worry, ballpark figures are okay. That way they don't waste much time. But you also know if they're scatterbrained, get them to go on the phone with your loan officer. It will be easier for them and for the loan officer. Okay? Takes about 25 to 30 minutes to complete over the phone. Can obviously be much longer if your client is a chatterbox, but it could take them 2 hours if they try and do it on their own online. All right, so let's take a look at the actual application. Get it up on the screen here. Just had it open. There it is. All right. Uniform residential loan application. Now this package I just gave you is actually 10 pages long. Pages 6 through 10 are the instructions. You need not read those now, and you may not need to read them ever, but I wanted to give them to you so you had them. Because if your notes from today aren't as thorough, you'll have this handy little instruction book to help you in the future. You're never going to take an application, all right? So you don't have to know it intimately, but you do want to know what your clients are going through in order to get pre-approved. It helps in those conversations we talked about earlier when you say, oh, so you're pre-approved, well, what exactly did they ask you? Oh man, it was long. They asked me everything from my social security number to who I owed money to and how much income. Now you know that they did one of these, right? If they say, well, he just kind of asked me how much I made and then he said I could borrow 400 grand. Okay, that's not a pre-approval. Okay, so the black lines designate the different sections of the application. So the first section is type of mortgage and terms of loan. That's where the loan officer is going to indicate to the underwriting department, hey, we're trying to go FHA or VA or whatever, right? And how much we want to borrow, what interest rate we're getting pre-approved at. So if I'm underwriting a loan and the prevailing rates are 4%, do I want to underwrite them with a 3% assumption in here? No, because that payment at 3% isn't what they're going to pay, and that pre-approval is meaningless. Right? Now on a fixed rate, they'll let you pre-approve it based on the prevailing rate. They don't ask you to pad it at all, because rates change every day. But on an adjustable rate mortgage, they actually will make you pad it, because they want to know, can this borrower afford the payment when it starts going up? Not just what it is for the first 12 months or whatever period, okay? And then amortization type, fixed rate, other, adjustable rate mortgage, or GPM. What's a GPM? You didn't know this was going to be a test.
It's a gross payment.
Graduated payment mortgage. So I can have, there's a product called a 3-2-1 buy down. And let's say the rate on the 3-2-1 buy down is 7%. That means I get it for a year at 5%, a year at 4%, and then a year at 5, then a year at 6, and then it's 7 the remainder. That's a graduated payment. It's not an adjustable because those payments are, though they're changing, the rates are fixed. They can't change, they're just designated to graduate over time. So that's what a GPM is. Not a super common product. Can be useful in helping somebody buy more house than they might otherwise qualify for. But is that always a good idea? No. This current recession has taught us that. Okay?
Quick question.
Sure.
If they are approved for a GPM, they would generally do that on the rate after that buy down period, right?
Right. They would, in my example, they would
Yeah.
make sure they could afford the 7%.
Okay.
Yeah. Yeah. And there's the 3-2-1 is actually less common. There's a 2-1 buy down that's easier to find.
Gotcha.
But yeah, that's exactly right. All right. Section 2 is the house that we're trying to buy. So at this point in the process, this field is going to say to be determined. Right? Our goal as an underwriter is to see how much they can afford. And in the absence of a specific property, we're going to see what the maximum is. And that way you as an agent can go, okay, my client's approved up to 400,000, then we should search for 400 and below, or maybe bump it to 420 in case you see a house that's been on the market for 180 days. You might be able to pick it up for 400, right? But that's what you want from your loan officer. Give me the ceiling, I'll work beneath the ceiling. And if I'm the loan officer talking to your buyer, I'm going to tell them the same thing. I'm going to first ask, what's your, I call it a payment pain threshold, the PPT. How much can you comfortably afford? And they'll say $2,250, let's say. Okay, what I'm going to do is get you pre-approved up to whatever the maximum is, but I want you to know that that means the purchase price of $340, let's say. So you're qualified to go higher, but at your payment pain threshold, the max price would be $340. Does that make sense? And they go, okay. Why do you think I do that?
Just want to see where their pain points at.
Yeah. And they go and find this perfect house at $340, new construction, let's say, but then want to put marble in, or granite, marble, want to put granite counters in. Now it's $345. Do you want to have to run back to your loan officer to see if they can afford the extra $5? No. Do you want to be able to tell your client how much that extra $5,000 will cost them in monthly payment? Because we're going over $2,250 now, right?
Right.
So you need to be able to answer that. Okay? And you can put an app on your phone that calculates an amortizing payment if you don't already have one. Or the shortcut would be just do an interest-only payment. What's the rate they quoted you? 4.5. Okay. 4.5 times 5,000 tells you the annual interest. Divide that by 12. That's about the impact on your payment. Now, in an amortizing payment, it'll be a little bit more because what I just calculated was interest only. But we're talking about $5,000 here, not $345.
Right.
Because all I'm communicating is the difference. I want them to feel good about granite or eliminate it. I'm not trying to talk them into it. I just want to know, does that $12 change what you eat at night? Is it top ramen because you got granite? Right? All right. Now you'll notice as you work through the property address, your bill, type of loan, purchase, refi, etc. Property will be my primary residence, secondary, or investment. Then you get into 2 rows of refinance data. Okay? So in a purchase transaction, you're actually going to skip down into title will be held in what names and manner in which title will be held. We never want to coach people on how to take title. It's not our job, nor our role, nor are we qualified to do that. Can we tell them what's most common? You bet. Right? A single man, a single woman, husband and wife as joint tenants. We actually live in a community property state, so they have automatic rights imposed upon them as a result. But then you can start to get into some pretty creative things like tenancy in common and right of survivorship and things of that nature. So all you want to do is know how you want to take title, and if they don't know the answer, tell them I'll be happy to have the title officer call you and he can explain the benefits of each, and then you can decide. The loan officer is going to tell him that because he's filling this thing out. Right? Source of down payment, bank account, gift, whatever. But the underwriter needs to know. Why do you think the underwriter needs to know?
You want to make sure you have money for it.
Wants to make sure you didn't borrow the money, right? You can't just have the money show up. They need to know that it was in your savings account, or if it's a gift, that the program allows a gift. But if they don't verify where it came from, they run the risk of you having tapped a credit card, and now your debt-to-income ratio just changed, right? The estate will be held in either fee simple or leasehold. Do you know the difference between the two? Diana does. Why don't you tell us?
Fee simple is when you own the property forever, right? And leasehold is when there's a lease amount on, or leased property, like the
Right.
estate, right?
Fee simple means you own the dirt,
Yeah.
right? Leasehold means you own the structure, but the house is sitting on dirt that someone else owns, and it's sitting there by virtue of a lease. That's the most common sort of title in condos, right? Because
And reservations.
Indian reservations, most of Hawaii, because the royal family set it all up on 99-year leases, because they didn't want to lose the land, right? But yeah, or in this area, Indian reservations are the most common. All right, section 3, borrower info. All right, we're gonna go kind of fast when it's stuff that's just mundane or boring to me, right? That's ultimately what matters, whether I'm engaged. So that's social security number, date of birth, current address, marital status, etc. All right. Section 4, employment info. They're going to list their employer and their length of employment. If they have been on the job for less than 2 years, they're going to list their prior employer. This is an important thing for you to note because you want to be able to sort of recognize that there's a potential issue as early as possible. So if you're meeting the client before they've been pre-approved and you're talking to them and you go, okay, great, well, have you been pre-approved? No, not yet, but that shouldn't be a problem. Okay, great. Can you tell me a little bit about your job? Yeah, I just got this great new job. I'm working for Boeing. Awesome. Is that a line of work that you've been in for a while? No. I used to sell real estate. Brand new job, no record of history in that line of work, you're going to have a problem. Right? Take that example right there. You could try and build an argument that the work that he does at Boeing is so mundane or easy that he could get the same sort of job at a bunch of different businesses and make the same amount of money. So if he's just a tech on an assembly line making $12 an hour, that's a little easier thing to say, well, you can get $12 an hour rolling out of bed, right? Take my example and flip-flop it. Used to be Boeing, now sells real estate. That guy's screwed. Because there's nothing to lead me to believe as an underwriter that just because you were good at that means you're going to be good at this. And that's why you need a 2-year history. Make sense?
For self-employed.
Same thing, 2-year history.
Okay, gotcha.
Yeah, great question though, because we get that all the time. I sold widgets, did it really well. I was the #1 salesman for my company for 20 years. I decided to start my own widget company 10 months ago. You're screwed. Because just because you're a proven successful salesperson of widgets doesn't mean you know how to run a business. Because those are not the same skills. Right? Make sense?
Yeah.
And it doesn't mean you're going to be delivering bad news to anybody. You just want to have your antenna up so that you can go, well, great. Make sure you bring that to Tyrone's attention early because he may have to pick a particular lender to make his job easier and help you get better rates. Right? That's a so that opportunity all day long. Make sure you disclose it early so that he can help get you the best possible terms. And then you get on the phone as soon as you're no longer with him and say, Tyrone, here's the story. Make sure you probe, because I think there's a connection between previous jobs, but it sounds kind of loose. I need to know that you're going to be okay with it. Right? Any questions on that? That's a pretty important or common red flag. All right? So you got a few extra boxes for for employment in case they've had several jobs in the last 2 years. Then you get to section 5, which is income. Why do you think they ask you to break down base, overtime, bonuses, commissions, dividends, rental?
So they can find the basic salary and all the payment.
So if they isolate the basic salary, are they going to ignore the others?
They always, most of the time they count the basic salary and the rest of them would be just a supplement.
Okay. They're not going to ignore them, but they are going to treat them differently.
They want to see how variable the others are going to be, how flexible they're going to be.
You're on the right
Or if they're
track.
consistent, like you're rental income.
If I am a loan officer, is a great example. Loan officers typically, not like in a mortgage brokerage, but let's say a Chase loan officer, they have a salary and commissions. If I'm an underwriter, I'm going to give them full credit for their salary, whatever amount it is. Let's say it's $2,000 a month. Okay? Commissions are variable though. What do you think I'm going to do with commissions?
Half it. at
Corporate.
least.
What is it?
Half it at least.
Corporate.
Right?
You're just going to arbitrarily slash it.
I mean,
No, I'm going to do an average.
yeah.
Because he may have had a $12,000 month last month and got shut out the month before.
Right.
What I want to do is a 2-year average. Just like I like to see 2 years of employment, if I'm going to have an income average, I want 2 years of income to average. Because it's pretty safe to assume that whatever you made in commissions over a 24-month window is about what you're going to make over the next 24 months, right? But I don't want to shorten that down to 1 or 2 months, because you could have an awesome summer and make nothing the rest of the year. And I just made a false assumption. Make sense? Each one of these lower numbers, so the base employment is the top one, overtime, bonuses, commissions, dividends, rental income, all of those get averaged. Because your overtime can vary, right? Bonuses can vary. Commissions we just talked about. Dividends and interest can vary. That makes sense? So the underwriter is going to be plowing through your tax returns. And if, in my Chase loan officer example, I'll get a W-2 that just says Vernon made $78,000 last year. It won't tell me that 24 of it was salary, the rest was commissions. So we use a verification of employment, which forces your employer to break it apart so we can then average it. Right? The box to the right of the income box, that's your housing expense. So if you rent currently, you're just going to have one number in that first column. If you own a house right now, like let's say this is a refinance, you would have principal, interest, taxes, and insurance, plus mortgage insurance if there was any, plus HOA dues if there were any. And then in the second column, you'd have the proposed new payment. But your taxes, insurance, and HOA are all going to be the same, because we're not affecting those. All right? Beneath that, there's some horizontal lines for other income. This is where people would list child support. If I sold a business and I get $700 a month from the guy that bought it for the next 20 years, I'd put it there. Those sorts of things. Okay? Any questions on income? And again, I'm not suggesting you're going to underwrite anything. But the better your ears are at picking up on red flags, the more swiftly you can solve them. And that just helps you be more efficient, and you do a better job for your client as a result. All right, section 6, assets and liabilities. The left column, it's always made me laugh. The left column is skinnier than the right column, and the left is assets and the right is liabilities. But that's pretty self-explanatory. When your loan officer is asking your client for their application, when they get to liabilities, most of them are going to say, I'm going to pull your credit, so we don't even have to go through this section. Because I'm just going to take whatever liabilities show up on your credit report and import them into the application. But it's wise, after you've gotten a credit, to go through and make sure that there's nothing in there that isn't theirs. Because you could have a truck payment. I sold that truck. Right? All right. The next section is schedule of real estate. So if they already own other real estate, this is where they would list it. And that's why it's still under the asset section. Okay? Section 7, details of transaction. This is where they will estimate, what's this deal going to look like? What's the purchase price and closing costs? How much money are you gonna need to close it? Okay? You can see that continues on to page 4. The last row, row P, says cash to or from borrower. If it's a purchase, it's always from borrower. Okay? Now if we go back to the bottom of page 3 for section 8, that's the declarations. It's a series of questions where we're asking the client if they've ever been bankrupt, ever been foreclosed upon, party to a lawsuit. Can you tell I've asked those questions a lot? I've taken applications without having the application in front of me, because I've taken a lot of applications. All right? Section 9, acknowledgement. That's where they basically are going to state that, hey man, lying on this thing is actually a crime. And it should be, right? You're giving misinformation to somebody to try and cause them to give you money that they wouldn't have otherwise given you. There's 2 cases in Oregon right now. Both of them just got sentenced, and the judge is being claimed for being a hammer. And it was mortgage fraud, where 2 different loan officers, different occasions, different offices, but they both got loans in people's names without their knowledge and took the money. And one lady got $260,000 through this scheme and 30 years in jail. Each one of you could make 260 grand in 1 year. And you will. If you work our systems, you will do that in more than one time. Why on earth would you throw away 30 years of your life even for an amount less than that? Or more than that? Who cares, right?
You guarantee we make 265,000 a year?
Do I guarantee?
You see how she bumped it up too?
Yeah, she's an extra 5 grand. Okay, section 10. This is also known as HIPAA, and it's a questionnaire so that the government can determine if the lenders are making decisions for the wrong reasons, i.e., are they rejecting minorities at a higher rate than they're rejecting non-minorities and those sorts of things. That part of the application has been there for 20 years, probably, as long as I can remember. Hopefully, it's a waste of data gathering because people make loans for the right reasons, not the wrong reasons. And then the last section is the originator certification. Right? So last section, but we're only on page 4 of 5. Page 5 of 5 is just a continuation page. If I had so many liabilities, let's make it positive. If I had so many assets that they didn't fit in the room provided, it would go on that last page. Okay? Any questions on the loan app? Is it how you remembered it, Diane, too, from when you borrowed?
Pretty much.
It's when I first got into business, it was 2 legal length pages. And then it went to 3, and then it went to 4, and then they changed it to letter length and made it 5.
I don't really recall doing as much.
Yeah. But as people got more creative in defrauding the lenders, they had to get more thorough in their questioning. So I don't have a problem with it. We just want the right people to be able to borrow money because we know they can afford to pay it back. Does that sound like a reasonable goal? I worked with a guy that said, you should be able to lend money based on a credit report alone. Don't need an application, don't need bank statements, W-2s, pay stubs, don't need any of that. And he's right. If your down payment requirement is big enough, you can tell what they can afford already. But that's a bit of a stretch. He was kind of a Wild West guy. All right, so now you guys know the loan application inside and out. Easy, hard, simple.
Straightforward.
It's pretty straightforward, isn't it? It's also one of those things where familiarity allows you to go faster. So That's why working with a green loan officer, it's not the end of the world, especially if they're driven and thorough and on top of their stuff. But they're going to have a harder time moving swiftly, and you're not sure you want to be their learning curve, right, or their guinea pig. All right, so now you know the loan app. So now we're going to talk about the road to full loan approval. I ran long second week in a row. I'm sorry. This section's not as long as that last one, though. All right? So you've completed a loan application if you're the borrower. Now what, right? You have this half-hour conversation with a loan officer, and he says, okay, we're going to get to work. Talk to you later. And you have no idea what they're doing. All right? So as soon as they hang up with you, they'll pull the credit. That's what allows them to import the liabilities onto that section of the application. Most processing software has the credit pulling functionality built into the processing software. Okay? Then they will run it through AUS. Anyone know what that stands for? Don't you love how I just like teasing you with acronyms? Automated Underwriting System. Examples of which would be DU, which stands for Desktop Underwriter. That's Fannie Mae's AUS system. LP stands for Loan Prospector. That's Freddie Mac's AUS system. And then some of the bigger banks like Chase and others have built their own systems for automated underwriting. The beauty of this is you can, like, I have literally had conversations on the phone where I took the application over the phone, pulled the credit while I still had them on the phone, ran them through the AUS system while I still had them on the phone, and even was able to draw their loan documents while I still had them on the phone. In 45 minutes, I went from nice to meet you to your documents are at escrow, when can you come in and sign? All in one conversation. And that's all because of these automated systems and their evolution. That's pretty slick, right? But when you run it through automated underwriting, it'll produce what we call findings. So it'll say, okay, 2Tran qualifies for the mortgage that you've applied for, because you have to put in what you're seeking, as long as you can prove the following. Because remember, when you're doing it over a computer, you haven't uploaded pay stubs and W-2s, any of that stuff. But the computer will say, as long as the pay stubs show X dollars a month in income, and as long as the bank statements show X dollars in savings, we'll make this loan. And that's coming from Fannie and Freddie. So the originator knows, okay, as long as I can produce the findings, I'm good to go. Any questions on that? Okay, so now I have the findings, and I need the documents to support the findings. We call those credit docs, because it's a credit application. But the credit application is a file that's about that thick, and that's because it includes all of these items. All right? So with the credit docs includes asset verification, which will mean 2 months of bank statements. Have you ever seen a loan officer's business card where they put this list on the back of the card? It's actually pretty smart. It's not a very hard list to remember. You guys will remember it from today. But when you want to give it to your client, he can just give the business card and say, these are the things I'm going to need. Okay? So assets is two months bank statements. Income verification if they're a wage earner. So that means a salaried employee. 2 months of pay stubs and their most recent W-2. If they are BFS, what do you think that means? Business for self. Self-employed. Right? If they're self-employed, 2 years 1040s. And if their company is a corporation, In fact, they're
It was terrible.
cursing. If they're a corporation, it's 2 years, 11/20s.
11/20.
Yeah, that's an IRS form, 11/20. If they are a partnership or an LLC, they're called 1065s. But it's always tax returns and never a P&L by itself. They'll ask for a P&L because they want to see that whatever income they verified is continuing, but a P&L is worth the paper it's written on, and that's about it, right? Lots of self-employed people are going to say, oh no, I'm fine, I'm well qualified. Last year was sucked, but this year's great. That's going to be a problem because they're going to average your income on the 2 years 1040s. They're not even going to average the P&L into the income in most cases. Some more aggressive lenders will. But you better have made money prior. Okay? Then other. What do you think other is for credit docs?
Other
Come up
income.
with.
What's
Other incomes.
other incomes? Yeah. Yeah. What was yours, Diane?
Whatever they come up with, it
Yeah.
seemed to be.
Could be divorce decrees. Could be, you know, your tax return or your credit report may have shown a judgment. So they might say, well, we want to see the documentation from that court case that you lost. Child support order, I mean, bankruptcy docs.
They wanted my CPA's verification because it was a family-owned business.
Yeah. Yeah, because if you prepared your own taxes, they're not sure, yeah. Who's heard of a form 4506? It's an IRS form. It's a request for transcript. And you will be
Yes,
asked,
I see that form in the short sale.
in every short sale, yep. And the reason they ask for it in short sales and for self-employed borrowers is because you can give tax returns to an underwriter. They have no way of knowing if those are legit, but they can request a transcript from the IRS and then reconcile them. And if the taxes you gave them say 300 grand a year and the IRS says 60 grand, then they know these were fraudulent, right? So that's the form 4506.
Along with 1040.
Yep. All right. So now we've got the 1003, the credit report, and the credit docs themselves, right? And we're going to package them up. That's our formal request. Remember, 1003 is an application to request credit. And then the supporting documents behind it are to corroborate what we said in the application. Okay? If in that documentation other questions are raised, like the examples I gave about judgments and child support or whatever, that documentation would be there as well. If your bank statements show, 2 months, your salary going in each of the 2 months and groceries going out, and then there's a $20,000 deposit. That's an anomalous deposit. So the underwriter's going to say, well, where'd that money come from? You remember why they want to ask that?
Because they're afraid that illegal.
Or that you borrowed it.
Or
They're not quite as cynical as you, but they definitely want to know where it came from.
You're gonna have a payment on it.
Yeah, exactly. They need to know that your debt to income is legitimately a representative of your ability to repay. Right? That's the stool that we're worried about. Bankruptcy on credit, so you provide bankruptcy docs. So depending what's in the documentation, it can trigger additional questions. That can be frustrating to your borrower, your buyer.
it is.
God, man, Diane, every time I talk to this guy, he's asking me for more stuff. Well, what did he ask you for? Bankruptcy documents. That's probably because they just got your credit and didn't know previously that you had a bankruptcy. Because remember,
How many years have you considered that?
on page 3 of 5, Section 8 declarations, question B, have you been declared bankrupt in the last 7 years?
So after 7 years, they don't have to provide that?
They don't have, no. The question is what the question is, right? Now, when I take an application, and I don't do it anymore, but I always said, have you ever declared bankruptcy? If they said yes, I'd say when. If it was over 7 years, I'd mark no. But I want to know, because it's not guaranteed to fall off the credit report after 7 years. It's supposed to, but it's not guaranteed to. So I want to coach my client and say, how hard would it be for you to lay your hands on your discharge papers from your bankruptcy? You might want to start digging those up, just in case. Right? All I'm doing is setting expectations, right? They're less likely to grouse, like the example I gave earlier, where they're going, man, every time I provide something, they ask for 2 more things. The more thorough I can be at the front end, the better job I'm doing, and the better I'm preparing them. Okay?
Quick question.
Sure.
Let's say someone did have a bankruptcy that was over 7 years old and it should have been discharged, but it wasn't. Do you know, like, if Academy has like a credit restoration thing or program
Yeah,
that
yeah.
we would be able to go into?
It's not through Academy, but we have another partner that
Okay.
helps clean up credit.
Okay.
I can get you his contact info.
I was just wondering.
Yeah,
It's like-
yeah. Great question, though.
Yeah.
Especially with all the short sales we're doing, right? Those folks, once they get through that process, they should immediately start rehabbing their credit.
Right.
And we're going to spend more time talking about that next week. Okay? Now all the documentation's assembled, it can be submitted to the underwriter. The last thing you ever want to do as a loan officer is submit a package to the underwriter that can't result in an approval, especially if it's purely because you left stuff out. Now, you know sometimes you're going to be submitting deals that are a bit iffy and you're hoping they're going to get approved, but you don't know. But you never want to get rejected because it's missing something, because you want underwriters to want to work on your loans. And they know, man, when Ed Lane submits a loan, that thing's going to have a payoff for me emotionally because I'm going to get to issue an approval. And that's what I like to do if I'm an underwriter. But if a loan officer does a lousy job and they constantly are leaving parts of the application blank and documentation is missing, those files end up at the bottom. And that's a disservice to their client, not to them. I mean, it is to them too, but, all right? Once the underwriter gets it, they have 3 options. Approve, deny. What do you think the third option is?
Modify?
Modify?
Send back
No.
to a submitter for completion or something to that extent.
In a way, yeah, it's suspended, right? Because something's missing, which
Yeah.
is what you were getting at,
Yeah.
right?
Yeah.
So their goal is to not ever deny, because that means that was all that time spent underwriting was a waste. So if there's an opportunity there, but they don't have enough info to issue an approval, but there's some omissions that maybe they can fill with, if the documentation that comes in says what it needs to, they can get an approval out of it, they'll suspend it. They don't really like doing that either, because that means they're going to touch a file twice. That's why you're always better off having a loan officer that puts a good package together. But they will suspend it if they think there's an approval in there, they just can't issue it yet. All right? Their goal is to approve you. They don't make money without making loans. Once approved, now you just need to find a house. And most approvals are good for 90 days. If a client says, well, I'm not buying for 120 days, what would you say to him?
Come back to me when you're ready, or speed it up.
I wouldn't push them back, right? You're putting them off. I would just say, no problem, as long as your circumstance doesn't change, you'll just get reapproved. So don't go out and run up your credit. Same advice I've given them, even if they're closing in 45 days. Don't run up your credit cards. Don't buy a bunch of stuff. Don't be late on anything. But as long as your income and your credit stays the same, there's no reason they shouldn't be able to update your approval. They'll just ask you for new pay stubs, new bank statements.
Now, when they run your credit again, is your credit hit again?
Good question. And I'll answer that next week. The short answer is, It shows up as a second inquiry, but the first inquiry falls off after 90 days. Now you know the road to full loan approval. And that is your number one goal. So just lock that away. Understand what's involved so that you can demonstrate patience and convey that patience to your client, because a lot of times they're not going to be very patient, right? Man, I gave him my stuff. He asked for the last thing on Friday and it's already Tuesday and I haven't heard it. Hey, underwriting can take 48 to 72 hours. And if you send it in on Friday, he may not have gotten it into the package until Monday. Don't worry though, just be patient. Let's go look at some houses, right? Somebody that's gotten all their stuff in, I'm more apt to go in the car with, even though I don't have the physical pre-approval, because the people that are sandbagging negative issues, they don't send everything in right away, right? They sandbag it. So somebody that quickly gets their stuff in, I'm feeling pretty good that they shot straight on the application, and we should be in good shape. Now we might be looking in 250 neighborhoods and find out that we can only go to 225, but that's all right. I'm still selling a house, and I still spent a few hours with them building rapport. Make sense? So remember, all of this information is meant just to allow your radar to be a little more powerful so that you can hedge off issues when they arise or get ahead of them and help your loan officer get ahead of them.